You're not.
Go ahead and call the meeting of the Board Finance Committee for February 2nd, 2026 to order. We've done that part. Move on to pledge allegiance. If you all please stand and we'll kind of do it all together here. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, roll call. Let's put it on the record that Trustee Aguilar, who just got over being very sick from the flu, was on his way here and was involved in a traffic accident. He was okay, but he cannot attend this meeting, so we wish him the best. With that, proceed with roll call, please.
Trustee Davis,
Present.
Garrett,
Present.
Thomas Stafford.
Okay. No virtual participation, so we'll 2.4, 2.5 changes in order of business.
The audit out.
Absolutely. So we'll move, let's see, we want it on the record here. We,
3.4?
is it 3.4? Okay, so our highly capable and intelligent board stenographer will move 3.4 up.
Before 3.1?
Yep. So change in our business, we've done that. Acceptance minutes, we'll do that for the next meeting. As with 2.7. 0.8, we'll move that to the next meeting. Any public comment? Nobody beating down the door, so we'll move on from 2.9. And section 3, we'll do 3.4 now, our audit report. So Trevor, Jeremy, whoever wants to lead us off.
Well, I just introduced Jordan, who is our audit manager on our annual external district audit with the company Crow. Crow also does the audits of our 2 foundations. Those aren't done yet, or
We're in process currently.
in process as
We're
well.
underway with that.
So what we do is we bring the audit report to the Board Finance Committee, and then we ask that it be accepted at our regular board meeting, which will be later this month. As you'll recall, we normally have this meeting hopefully late November, early December. But because of the federal shutdown, because of some delays on some federal type OMB regulations, there was a delay in that. So although this is later than normal, we are technically on time as it relates to the revised deadline for getting the audits approved. And with that, I'll turn it over to Jordan, who has an update for us.
All right, thank you, Trevor. Hi, everybody. Thank you for having me out here today. I am very pleased to report that we have issued the audited financials for Yosemite Community College District for fiscal year ending June 30, 2025 with an unmodified opinion. This is going to include both the federal and state opinions as well. So an unmodified opinion is the highest level of assurance that we can offer as external auditors. This is exactly what you want to see on your audit reports. Good. I was like leading with that.
Now that's like
Okay, we can go.
triple A.
Oh, there's a finding.
There are a few things that I have to communicate to you all, so I would like to go through that right now. We conducted our audit in accordance with generally accepted auditing standards, which provides reasonable and non-absolute assurance whether the financial statements are free from material error, whether caused by error or fraud. Concept of materiality was applied. That means that we don't look at every single dollar, every single transaction. We take into account the value that we would determine would change the opinion of the user of the financial statements. So that would be the board or anyone else who relies on the information presented on the financials. We have to maintain independence as your external auditors. So auditing standards require us to maintain independence for all audits, and we confirm that we are independent auditors with respect to the district with the independence requirements established by the AICPA. We did not note any significant nor unusual transactions that the district has entered into. We did not find that there are any significant accounting policies in controversial areas. There were 2 new accounting standards that were implemented during this year. The first one is GASB 101. I had previously talked to you all about this when I did the pre-audit presentation. GASB 101 takes a look at compensated absences and requires the district to evaluate whether or not these absences provide have a liability to the district. And what it really addresses is sick leave, which historically hasn't been looked at. It's mainly been, vacation that gets paid out. And so GASB 101 required the district to manage to evaluate the sick leave usage over historical trends to say, would this create a future liability that's material to the district? And upon investigation, the district determined that it wasn't. And us external auditors evaluated the calculations by management, and we came to the same conclusion that we're in agreement with the immaterial implementation, thus not implementing it in this current. GASB 102 was also in implementation this year. It had no impact on the district, but GASB 102 just requires the district to add clearer disclosures on their audited financials about major financial risk, such as reliance on state funding, restricted resources, or exposures to losses, none of which apply to the district this year, and this is a disclosure-only standard. I have to communicate about our judgments about the qualitative aspects of management's judgments. The financial statement areas which require management judgment are primarily the useful lives of capital assets, the collectability of receivables, and the liability associated with employee benefits such as PERS, STIRS, and compensated absence. Overall, we found that these accounting practices applied to these key areas are appropriate and consistent with other districts of similar size that we audit. During the audit, we did not encounter any difficulties nor disagreements with management. There was no consultations with outside accountants, no difficulties in obtaining audit evidence to complete our procedures. We had no material weaknesses. However, as was alluded to, there was one significant deficiency identified in the audit this year. This relates to the return to Title IV controls. We found that 2 of our selected students had earned all of their Title IV award. However, due to a control failure in the review process, this calculation was performed for these students and the money was returned. However, this has now been remedied, and through our evaluation and discussion with the district, we identified that we recommend there needs to be an additional layer of review in the R2 T4 calculations. District is in agreement with that and moving forward to figure out just how we can enhance the control surrounding that. We had one unposted audit adjustment and one posted audit adjustment in the year, both of which are related to construction in progress. The waived audit adjustment was to bring on the beginning balance, and the posted audit adjustment was to make sure that the ending balance needed to be where it should have been. The waived adjustment was about a $2 million impact beginning balance, and then the posted audit adjustment was about $8 million. The waived adjustment was, as I mentioned, just to impact beginning balance, but we worked with the district to figure out what ending balance needed to be for work in progress. So we went ahead and made that correction. And that was the only impact for audit adjustments on the audit this year. Does anyone have any questions about anything I just said?
Well, just that your ending balance becomes your beginning balance, and then what?
So construction in progress is kind of one of those weird things where the district makes payments to construction contractors and expenses them throughout the year. Then when we do GASB 34 conversion entries, we need to take those expenses and essentially reclassify them as to construction in progress for anything that's not fully completed yet. And then when it does get complete, we move it into a depreciable category. So the ending balance this year, we made sure that through all the ins and the outs and things that got completed or started, that we knew exactly where the ending balance of construction in progress was at 6/30/25. So that's what's reflected on the financials.
So for someone that's gonna be watching this later, they can't sleep. So let's have a layman's person explanation of what you talked about with Title IV.
With Title IV, got it. So Title IV, when a student signs up for classes and are eligible to receive student financial aid disbursements because they apply and they fill out a FAFSA, that student is entitled to X amount of dollars based off of their original signing up for courses. If at the future that student decides to drop courses or they fail to attend courses, they get a failing grade, or they unofficially just withdraw from the college altogether. That triggers an event where the student didn't earn all of that money and they have to pay back a portion of that, right? That's called the return to Title IV, right? What happened with this instance is two of these students went and completed 60% of their course load. And once you hit a 60% threshold, that triggers an automatic, you've earned 100% of your Title IV. The students went past that 60%, but then dropped subsequently. And then they got picked up in a Title IV, return to Title IV calculation was performed and conducted over those two students. But, you know, they earned it all and they didn't need to be performed, but it was performed. And that part didn't get caught in the review process.
So just doing the test or whatever, just getting them in that process is wrong.
They shouldn't have been picked up, correct? Yeah, because they earned 100% of it by completing 60%.
So was there money taken back by
Correct.
mistake?
And it was like,
I didn't hear that part.
it was like $300. It wasn't a lot of money. Because it was just two students. It's not a tremendous amount of financial impact. But we do feel that the controls surrounding the review process, that's what allowed that small dollar amount.
Got you.
Kind of
Now,
mistake.
the two students was part of your random selection of
Correct.
students, so it
And
could have been more.
We actually, in response to that, we expanded our selections
Ah.
over that population to make sure there wasn't further kind of mishaps or human error, you would call it that. And we found that through our extended testing, there was no other instances of it. It was only two of the, I'm kind of going off memory right now, like 2 out of the 28 people selected from that campus. And then the other campus didn't have that issue. It was only identified at
Columbia College.
Well, on one hand, it's a good thing to hear that we got this review.
Correct.
That our colleges are looking at, and probably what triggered it when the students dropped.
That's exactly what happened.
Yeah, and the error came that they didn't do it. They did what they needed to do, but they didn't do a deep enough dive to figure out, okay, they passed that threshold. We're okay.
That's exactly, you're describing it, what happened. And so, our recommendation is just, we need another layer, another set of eyes, to make sure we don't run into similar situations moving forward.
I find it ironic that you only need to do 60%, which is basically a D. And
Yes,
and you qualify to get your 100% of your funds.
There are rules in place where, right, your grade point average impacts whether you can get future aid. One of the interesting things is if we're doing our job well in the financial aid offices and we determine a student left at 50%, we might reach out to them and say, hey, how can we assist you so that you come back next term? And by meeting with a counselor and looking at their future plans, that can actually get them past the 60% mark. So we have ways of trying to assist students. This is interesting that it's normally you would catch someone that we didn't do the calculation. It's interesting that we did a calculation when we shouldn't have. So I think that the colleges will hopefully learn well from this and keep that in mind as they continue to do their processes for the next term.
But to say the least, because of this incident, financial aid at Columbia College is getting reviewed very carefully. And we are looking at the management team for accountability. And that's really thanks to the auditor and the district to put these in place. We are aware of this, but it's unfortunate, but it's a good way because now I think what it does is bring to light to Columbia College, you have to pay attention. So luckily, not severe, but good enough that a good lesson to move forward that everybody's on par. So thank you.
Very well said.
I think Christy Garrett wants an in-depth analysis of the net pension liability as well.
No, I don't think anybody else does, but No, I mean, it's interesting when we include this in here, because you're required to, under GASB. But on one hand, it's out of our control.
It's very much out of your control, and the fluctuations a lot of the time have to do with the market.
Oh, sure.
How the actuaries come and they assess, mortality rates, the market rates.
Yeah, I just went through all that.
Yeah.
On County Retirement Board, we just had our actuarial review for
Okay,
the fiscal year ending, same thing. So, yeah, it would definitely bore you. I know.
not really. I actually find this very interesting, but.
I muted. Yeah, yeah, no, it is fascinating, but it is out of our control. Only thing in my mind where this becomes relevant is if at some point down the future, we decided to, which we wouldn't, but pull out of it. And then this is where your liabilities come into play.
That would almost be impossible. Yeah, that would be very tough.
Yeah.
Well, people have looked at it and then they look at the numbers and they're like, yeah, we're not going to do that. So, yeah, but, skip forward to our OPEB trust. It looks like we're doing,
Page 41.
Yeah, looks like we're doing pretty good.
It is showing 116%.
Yeah, that's what so I don't see any,
Well, when we exceed 100%, do our contributions change or do we?
No, we should always evaluate to make sure that we're not overfunding intentionally. And that's where we're doing an actuarial report every 2 years with an update every 1 year. And I asked the same sort of question of our advisors, what should we be looking at? And the reminder is you're one negative return away from not being fully funded. And so where PERS got themselves in trouble 20 years ago was we're always going to be rich, so let's provide more benefit. And so I'm thrilled that we reached 100% at one point. I think this is the highest that we've ever been. But we are on 12 plus years of a booming economy. And so eventually there will be at least one down year. And so we will likely continue our process as is with our actuary.
So we pay out now, you have one group and then you have another group. Yeah, we paid out till age what?
Is some people lifetime benefits still?
70, yeah, I think it's 70 for the original group and down to 65, I believe, for the second tier.
And then we still have the original, that's a lifetime.
We've never had a life.
Never had a lifetime.
70.
It's all, I was
70.
But our benefit payments in this year were 4.1 million.
Which has gone way up.
Yes, but yet our employer contributions were only 3 million. So it's needing those high balances to then generate returns, which then assist us in.
Right, but the reason why we're what I think is important to clarify on this is the fact that employees are not making contributions to this. It's a totally reliant upon employer contributions. And therefore, as you put more and more people onto this benefit plan, that's why, I mean, just a few years ago, our benefit payments were like 2 million something. And then we went to 3 million. Now we're at 4.1 million. So that tells me that even though the benefit's been capped and fixed, we've had a lot of people retire and adding to that pool, which is going to increase your liability. So yeah, you get one bad year, 2 bad years, and all of a sudden now you're
60% funded.
yeah. And you always want to look at 80% is kind of your threshold. If you're around 80%, you're good. You get below 80%. Now you gotta start rethinking things, but right now we're doing pretty good, so.
And in the budget, we moved out the transfer, one-time $1 million transfer, so that's could be added into the future if questionable, but that was the plan.
But we're it's just gonna keep getting more expensive.
Mhm.
Anything else?
I make the same recommendation every year that we not have Crow at our board meeting.
That's fine.
Jeremy and I are usually both there if there are any questions that come up from the full board.
Yep. No, that's fine with me. Yeah, thank you very much. So,
Whatever, normally it's, yeah, there's a finding, here's what happened,
right,
And then, no major adjustments or no, what'd you say? No adjustment.
Well, there was the one for construction in progress. There's another one that Jeremy and I talk about every year, and it's Cashin County. And there's a potential adjustment that
This was
was,
not big. That's your head. No.
oh, okay.
Material.
I thought it was like 2 million.
Material adjustment.
No, it's just something. What you saw in the management rep letter was like the impact.
Oh, okay. But anyway, I know that if I go to the county treasury and I ask for $101 because that's what it's worth, they're only going to give me 100 because they don't do that adjustment, right? So it's one that we chose not to book over the years. I think districts vary from district to district, but again, you indicate it's not material this year, so.
But most districts actually don't book
Okay,
that entry.
good.
It's kind of what Trevor's saying. It's it's unrealized and you can't ever get the extra $1. You can only get 100 and it goes the other way too.
Yeah.
If they only had, you had 99 on the books, and you said,
Yeah.
give me 100, they're going to give you 100.
Yeah.
interesting. Okay, well, thank you very much.
Okay.
And we'll move on to 3.1, the quarterly report of district financial.
Do we,
We'll make a recommendation.
Yeah, so we're gonna
We'll recommend approval.
I think it's acceptance by the board, not,
No, we're just-
yeah, no, but there it's.
Yes, it's an acceptance of the report. Full board, yeah.
recommend acceptance.
3.1,
Yep, 3.1, our quarterly financial.
or you want to start when it's,
They're gonna be on the screen or?
Yeah.
First portion of this is the report that we submit to the state and those are the numbers and you can look at them if we want to, but the bottom, the last page is really the one that has the summarization based on our district. It's a little more familiar to us. So we have the quarter ending December 31st, 2025. So our financials, we're showing a top portion of the revenue. Couple things I wanted to point out is the non-residency tuition again is higher than budget. We've had that conversation about keeping the budget where it is because it has effects moving forward if we increase it. It is still showing the 1.2 million so far this year, which is quite a bit more still even than the prior year over budget. So
the 1.2 million as of that date realistically would have had the enrollment for spring included possibly,
we've had a good
portion.
Yes,
unless they were last minute registrations.
correct.
What's driving that? Is it our online?
Well, we're flat, or like our enrollment for it is like pretty much flat. It's just that there's a fee increase every year, just like you're taking a look at it again today for the fee increase for 26, 27. So we haven't seen a major influx in non-resident students. It's just that fee incrementally goes up each
Gotcha.
year.
Okay.
That might be another reason we might consider increasing the budget in a future year. But if we remember also any in non-tuition residents, does that go into?
Non-tuition residence fees are 100% allocated to the colleges. And so if we don't give them to them in the current year, we true it up and provide it to them.
Right.
in the subsequent.
We'd rather not give it back. We'd rather it be short, have them give it to us the following year.
So that's that increase there. Then we have the interest revenue. Again, if we remember, we increased it from 1 million budget to 2 million budget this year because it was quite a bit more than it was last year. If we look at it, that's why we're 152% last year, but we're only 71% this year. But we did increase the budget by $1 million. We doubled.
Is that all county treasury or do we have other investments?
All
It's
county
all
treasury.
treasury and there's some other counties, not just our county, but there are other smaller amounts, but all county treasury basically. And it is, the total amount is slightly lower than last year, not much, but 200,000 so far lower. But the percentages are that we could increase the budget by $1 million. And then if we also look at the other revenue, we're 882 budgeted for $1.4 million the current year, which is 166% higher. And that's due to a solar refund that we received for the solar power. That's 681,000 that was
Nice.
loaded into the revenue. We'll plan on have some plans for that. I don't know if everyone wants to speak to that or not, but I think it's going to move over to Fund 41 as an option there. We haven't fully.
Now, is that part of the program where we took a loan?
Yes.
Thought we were using that to offset the utility expenses.
The program has helped us realize lower kilowatt hour usage. When we applied for this program, what we didn't realize is that the federal government would actually give us 30% rebate on the cost of the solar program.
Oh, so that's a one-time.
That's one time, yeah. And so realistically, the goal would be to transfer that over to Fund 41 to deal with other construction related projects, especially as it relates to energy efficiency.
I'm sure that our maintenance department would not object.
Scheduled maintenance.
Scheduled maintenance.
Needs a little.
Now, is that? So we got this additional revenue
One
coming.
time, yes. Mhm.
But if you pull that out of there, is it paying for itself with the loan and all that?
If we remember, the loan is a 1% energy, and the idea that we could have left our money in the bank and used the state's money to do it, and we're earning closer to 3% plus in county treasury. So there's there's already some of that going on. When we look at the utility usage, it's so difficult because we came out of COVID. So we went from literally no one on campus and we're busting at the seams now as it relates to the number of students that we have. So it's very difficult to say building by building, has this improved or not, because our hours are longer within the facilities. We do look at that, we do track that. But our utility bill goes up because, especially in the Modesto area, we got hit with 2 or 3 back to back to back.
Right, so they track usage and costs separately. Our usage has gone up slightly because, yes, the campuses are fuller and we're electrifying more things. But we're trying to track that data enough post-COVID, because all we have are pre-COVID numbers and that we can really compare back to. But our usage has gone up in alignment with our enrollment.
It's gonna be interesting down the road because I'm already hearing stuff with artificial intelligence that you can manage your utility costs. You know, because if the AI perceives that an area of a building or whatever is not in use, you can put sensors in there and everything, then it can start taking things down.
Part of our evaluation as we move forward is from buildings that are 20 plus years old and mechanical systems that may be reaching 20 years old, that to have new and improved mechanicals will assist in lowering those costs. Now, they don't take them away, of course, but they prevent them from growing exponentially.
So that shows our revenue figures there, and we're higher currently than prior year, and discuss some of the changes for that.
Question on lottery. Do we consider that one time, or do we, because it's been around so long?
It is ongoing.
So we don't store it away. It's part of our operating expense.
Correct. It is in the unrestricted general fund. It is part of our budgeted expenses. The restricted lottery goes 100% to the two colleges. But I believe we use utility and a few other service-related expenditures to zero out the Fund 11 lottery comes in. Insurance as well.
I'm just wondering if everybody got religion and stopped doing the lottery. We've been.
Luckily, it's 3.1 million, and as it relates to the total budget, I think it shrinks over time as part of the total budget.
Then we have our expenditures, below that MJC is showing it, slightly lower as a percentage of their budget, total through December 31st. Columbia College is showing, quite a bit lower, but that's due to the $2 million dorm, in the prior year. The budget for, the dorms is $2 million, and we extend that all up front when we transfer it over. So, if I removed out the dorm, for the dorm figure, the prior year would be, 42.5. So it still similar to where we are, from where we are currently, just slightly lower. Central services is slightly higher, and our contingencies are quite a bit higher. That's because we have that 9 million, well, 8 million of it is the transfer over to Fund 41, and it's all, again, also done upfront. So it skews the numbers a little bit because those budgeted expenditures are all happening in the beginning. So in total, we're showing our total budget being 42% of total actual. And last year was only 40%, so it's slightly higher. But again, those larger numbers in there in the beginning of the year will skew the information to that direction.
Still doing good though.
Still doing, yes,
Yeah.
doing well.
Yep. Any questions, Don? Okay, well, thank you. 3.2, the full-time equivalent student update. Mary?
Okay, so today we'll just focus on the purple column for 25-26 estimated FTES. I ran this data for that column on January 7th, and this is the information that was reported, the total FTS that was reported on the first period 320 report to the state chancellor's office. So instead of doing a more recent update, I just wanted to provide you with what we reported at P1. I did, however, look at the sections in the system this morning, compared them to at that time period, and it's maybe like 2 section difference. So we're still looking pretty much at the same information. So first we'll take a look at the first column for regular summer sections in purple. We have 2,041 FTS that we reported, and that includes all hours in the system. I didn't have any additional estimations at that point for that term. So that's just what we reported, and that should stay basically at that amount unless the colleges find any adjustments they need to make on student enrollment. And then for our fall column in green, we have 7,671 FTS. Now that includes some projected positive attendance hours for some sections that weren't able to get their hours in on time before that report, since I did it so early in January. But majority of that is our actual FTS. So at P2, we'll see that probably shift slightly, not a significant amount, just based on whatever the actual positive attendance hours end up being for those sections. There might have been about 10 that we were missing positive attendance hours for that I provide a projection. And then for our spring term in blue, I reported 7,310 FTS. So this was a pure projection based on average enrollment for the sections that we had in the system as of January 7th, because we did not start our courses at that time. We had not hit first census. So that was just basically a calculation that we did outside of the system, looking at our average enrollment for those sections. And that is what we came up with. You know, looking now, I'm seeing about the same number of sections, so I'm not expecting it to shift too much, but I think this was more of a high projection. I'm not expecting it to go past that. But that's what we're still looking at. And then for our early start, we're just flat at 663 prior year. So just dependent on that, what the colleges decide to do with the early start versus regular start and how they do their scheduling for summer. But we have not begun enrolling or anything, so I don't have the data yet, the final data to do any projections at this time. But at P2,
In April, we will be projecting all terms out based on the current enrollment. So that will be included at that time. So we are looking at 17,685 for our P1. And then down in the notes, as requested at our last meeting, we included some of our unfunded FTS information under that total. So we first put our actual unfunded for 24-25 for last fiscal year, which ended up being 39.55 FTES. And then right now for 25-26, we have an estimated based on the 17,685, kind of putting that into our, our calculations that we have, looks at an estimate of around 933 FTS. But this information will change after P1 once we get more information from the state on our revenue.
Well, can we keep that trend up? I mean, that would, that's a lot. From one year to the next, right?
Well, Lena and I are going to have a conversation with the chancellor's office at some point. The unfunded FTS is very frustrating. The way that growth is applied, the way that we're a 3-year average, and in our 3 years, one of those lows is incredibly low. One of those 3 years is incredibly low. And so that is having an impact on our 3-year average. The 932 is my guesstimate. I put it through a system and I think it's reasonable. I'll be curious to see how it shakes out actually any day now, huh? We should be getting P1. And so it could be slightly more than that, slightly less than that. The easy way to calculate it is 5,000 times that number, and it's about $5 million of unfunded. Now, again, I like the work that both of the colleges are doing is they're not going crazy on their schedule. They're adding where they need to. But in a sense, it's more efficiency within each section that's being offered. There are more students in each class. And as it relates to the revenues available and the opportunities for this community, I look at it as a way that the board can share with the community. We are serving the students, that even though there isn't this funding, we're trying to be as creative as possible to make sure that any student coming our direction, we're trying to do our best to make sure that they can take classes. So we do continue to assist MJC specifically. I think there was one-time funding in the current year budget as relates to funding the schedule. We need to continue as we have new revenues available to make sure that they're going out to the site so that they can continue to fund the schedule, and for each site to kind of evaluate what their needs are. And so again, there are no directions of, we need to stop with unfunded FTS. It's not a direction we're going at this point in time. And while the state budget continues to look reasonable, I think we should continue with the status quo as it relates to allowing the colleges to develop their schedule.
Laura, I believe Keith Fuller on February 20th.
With the other lady?
Yeah, well, that's another different meeting, but for our YCCD priorities, which is the funding that is unfunded, and there's other colleges too. So there's multiple things too. Trustee Davis, you were there last week.
Yeah,
but,
and you talked about getting a Zoom with the lead of the education.
Yeah, that's
committee.
Patel for
Patel.
the SP, and for the rural, and that will
Well, we could put it
connect
all
that
together. You got her
Yeah.
captured. Don't let her
Oh,
off.
yeah. So it's on our radar, but just know that there's a few colleges with growth too. Yeah,
Especially Central Valley.
yeah, there's, the rural community,
Yeah.
definitely Central Valley.
Well, I agree, Trevor, with what you said. This board made a commitment to the colleges that you can target the classes and target them away. That's where the demand is at. To fill up, we need to support that. And I agree with that. I would just, if you trust that, and you said you ran it through and everything, that's fine. I think that's great. We asked for that. We need to put that down as a footnote when you do these reports. Because if it's 5 million at the end of the year, well, that's 5 million that's coming out of, our overall resources. That way, people can't say, well, you got an extra, no. We're going above and beyond to make sure that we're serving the community. So I'm not saying it needs to be
Yeah.
in here, but if you can put it down as a footnote, to provide a little more clarity, I think that would be great. Don, do you?
I do, and that's, we're serving students and man, we have facility needs, we have curricular needs, we've got equipment needs, but we're doing the best to get kids their units. And with all.
That's just the unfunded portion, and you're right, that goes back to what you were talking about, then you start throwing in all the resources of utilities and all of that to service those additional things that we're not, so it's probably in the end, it's probably gonna be more like, I don't know, 5.5 million or something like that if you add it all in,
Again, it's not all from adding new classes, right? A lot of it is just more students in those same number of classes. There probably is a small increase in the number of sections at each college, but not unreasonable.
Well, that's not too bad if it's a small number of sections, but what pushback are you getting from instructors, or class size and that, or any at all?
They're well protected on the way that
Access.
calculations go.
So,
And
yeah,
that's an interesting point that Sarah raises because once you hit certain numbers within the classroom, there's actually a stipend that a faculty member gets. So remember, they're getting a stipend, yet we're not collecting the revenue.
There you go.
For those additional students. That's the thing that we'll have to.
So factor that all in your footnote. And trust me, we'll address that at this level and at the full board meeting. I have no problem.
So are we talking a footnote on the financials that said this is how much?
Just on what you, this little document here, not what you send the state's not here. But for our own education and community's education to say, hey, this is what we're doing.
We would do under number 2, state apportionment. We would have a footnote at the bottom that says as a first principle apportionment, and we'll have a calculation that we can utilize.
That good? Makes sense.
And I don't know if we'd want to include that in the RAM as well.
No. Just for this right here.
Yeah.
What might be interesting to know is what capacity exists within the sections we have. I mean, if we have kids on waiting lists because they can't get a section, is it just because they've got conflicts in their schedule or their courses are not available or what that is? Because we are loading up to class size limits and are you hearing, hey, I can't get the courses I need because they're not available?
We still have significant wait lists, just like for fall. I think the dean stopped counting for English at over 1,000. So it's
not just your science.
It's not just the sciences, it's a lot of our classes. And the problem too is that sometimes in some areas we can't find instructors. In some areas, we just don't have the capacity to seat anymore. Our classes are full, even though we have significant number of online courses, we're at capacity for a lot of the time. Now, does that mean that we could offer classes at 7 o'clock in the morning or more classes at 6 o'clock at night, classes on the weekends?
Or we could look and see what are those are they repeating classes, right? Because we really want to look at completion rate. Are there wait lists because they have to retake the class? So that is the kind of data that I look and ask Luca for his team. Then we'll get a really accurate to see if those waits are repeaters or new students.
I think that's kind of maybe it's on the other side of the equation. We have additional FTES that we're not being funded for. And if we receive that funding, that $5 million, we could offer, if we had the instructors in sections for the waitlisted students.
Well, Sarah, you bring up another good area for discussion. Is there demand for early in the morning classes? Is there a demand for more evening classes at the time you stated? And is there still a demand, or is there a demand for weekend classes? We know that?
I don't know that off the top of my head, but I can ask the team if they've done a survey or anything like that in order to be able to get that information.
Yeah, be interesting to find out. Have a targeted approach. And if that means, we're still doing good and that's how we need to move things around and be more strategic, then let's do it. Okay, we did 3.4 already because we took that out of order. 3.3, thank you. Okay, 3.3 is the 26-27 non-resident tuition fee. Is a annual customary item.
It is, and a few years ago, the options expanded from like 5 options to options, and it used to be calling all of our neighboring districts. Hey, what are you going to charge? Hey, what are you going to charge? And we're all waiting for the first one to actually put it on the board agenda, and we say, okay, we're going to piggyback off of them. And remember, in our district average cost, that not only includes Fund 11, it also includes Fund 12 in the calculation. And so you can get a little bit screwy on your district average costs on items that actually don't impact what goes on in our classrooms. It could be a statewide contract that we're offering. We have the K-16 collaborative up at Columbia. So there's a lot of expenses that don't necessarily relate to what we do in the classroom. So I've fallen in love with number 8 there, this gradual moderate increase from prior year. And it is something that I've been selling to the other districts when they ask us what we're doing. Delta just emailed me late last week and I said, here's our process, here's what we're doing. So I think we're on about at least 2, maybe 3 years of doing this, where we take a 5% increase on the prior year, which you will see, my calculation is a gradual moderate increase, which complies with the education code. And then when you look at our neighbors, last year Delta used 312, Chabot Las Positas used 370, Merced used 320. San Jose Evergreen, which come on, that's about as far as you can get over the hill from us. They're at 382. But when you see that last year we charged, if you scroll down, I'm missing it, or is it right in front of me? Last year we were at 322 and now we're proposing 338. So we're very near our neighbors. There's a lot to be said of not being way ahead of your neighbors, because if it is enough of a dollar amount, the students will say, you know, I like MJC, but Delta's just a few minutes away and it's need to get there as well.
Well, we want them saying that on that end.
Correct. So, and again, I don't want to artificially understate the amount, but I think we do run this through the student services vice presidents, get their approval that they agree with the calculation we're coming up with. And again, so this will be on the agenda.
And Merced's at 352. Merced looks like. Or that's their average cost, what they're.
Oh, their average. So last year they used 320 and again, we used 322. I imagine they're going to be doing something similar, which would realistically be a 5% increase.
Sounds good to me. And it doesn't sound like it's a problem shopping around. So it looks pretty good. All right, thank you. We'll move on to 3.5 with this budget proposal.
We had a board study session where we talked a little bit about the budget. And so we included for you in your attachments, I think 2 different documents. One's a joint analysis, governor's January budget that the chancellor's office puts out. And then as well as the higher education chapter of the budget from the governor from the Department of Finance. And I really won't go through those unless you have any specific questions.
We received an update up at Sacramento, and it was not very good update. However, basically the LAO was saying it's a bunch of junk. They always do though. But they were making a real case that we don't know where the governor and the DOR are getting their projection, because we don't see it that way.
And I would say that's absolutely true as it relates to the full state budget. With Proposition 98, with the protections that we have in place, if anything, he's understating our budget. And he's understating our budget from prior year corrections to the tune of $5 million, so he can give that money to the CSUs and the UCs, because he's made promises that he's trying to catch up on. And so what is good for us is us being associated with the K-12s and the CTA, I think annually filing lawsuits about we're not getting all the dollars that we're owed, and the governor usually agrees and says, we'll do a true up. And so those true ups come a year or two later. But we are confident that the state budget will have enough for the COLA, enough for a 0.5% growth. They're even proposing to add 1% growth, although it's in the budget year 26-27 to actually apply it to 25-26. And that, as I described to you at that study session, actually is not good news for us, because based on the way that things calculated, we're not going to be achieving nearly any of that 1% additional growth. So that's why we work with the chancellor's office, see if we can do something different. There a way that it's where it best benefits the district, where that 1% show up. So there are some categorical programs that don't get COLA, and within this budget proposal, they are proposing to give them some COLA. And then finally, deferred maintenance sounds wonderful at 120 million, but when you take our share of that, I calculate it's like $1.5 million. And then when we give half of that to instruction for instructional equipment, you really don't have much of anything. And so the idea that we continue to utilize some reserves to help support our deferred maintenance is well noted by our facilities department, and is what has been instrumental in helping us continue to do projects over the last several years. That's it for me as it relates to the budget.
Well, my concern is when you look at between what the LAO is saying and what the governor is saying, I see what the governor doing. He wants to go out on a semi-high note. Because he's running for president of the United States, and I say good luck with that. But you know, there's a $14 billion disconnect between him and LAO. And that causes me concerns, because if it's worse, that just adds to that number next year. And what are they going to cut? You know, they're going to cut our time, or what do you call it there, our on behalf revenue for CalSTRS. They could, you know, and you know, that's a $4 million hit to us. There could be other things that get cut. I'm concerned at the federal level. You know, because right now we're running a little over $2 trillion deficits every year, which is unsustainable. And you've got you know, global hawks and the government talking about they want to increase the Defense Department budget by, you know, 500 to, you know, $600 billion. And it's just not sustainable. Now you're looking at running deficits of, you know, you might as well, you're running a deficit of 3 trillion. I mean, that you cannot do that. And so that you're looking at state problem. Now you're looking at a federal problem, and we're trying to serve our students. So, you know, I'd like to take everything and put it into Fund 41 and make sure that, you know, our facilities are where they need to be. But at the same time, you got to plan for the future, because you don't know what's going on. So it's a complete unknown right now. Don?
Well, and the governor is going to leave it for somebody else.
Yep.
Yeah.
Not my problem. I don't know. I just think, you know, being conservative like you are in your budgeting is the best way to go.
Yep.
Not getting too committed on things with your ongoing funds that might not be there. I think you guys do a great job.
Yep. Any other questions? So we're looking at about a 2.4% COLA
At this time, yes.
And I would really at some point, I know we talked about it before, but we've got to, given all that and planning for the future, we got to get out of this idea this expectation that if COLA is 3%, everybody gets a 3% salary increase. COLA's at 2.5%, everybody gets 2.5%. I've been in government, I worked for government for almost 27 years. I've sat on both sides of the table. I've never, this is the only area of government.
And every day.
Everything is bargain. And you find out what you're gonna get. This idea that everything is just an automatic, well, that's what it says, that's what we want. You can't plan for that. You can't plan for that.
Yeah, conversation at the board level. I mean, we never had a COLA pass through in all the years, but some years raises were higher than COLA, other years they were lower. This idea that it's a pass through. Anyway, that's not for here, but
No. Okay. Any other questions? Going once, going twice, okay. The next Board Finance Committee meeting will be held on Monday, May 4th, 2026 at 1 p.m. right back here in the district meeting room A. And with that, this meeting stands adjourned.